I'm assuming people confuse this a little bit. So is mortgage insurance the same as homeowners insurance?
No, it's not. And so the whole world of insurance is a complicated thing, right? We're going to keep this very simple, but it's confusing even if you've gone through this process several times and you're a veteran home buyer. Sometimes it's hard to keep all of these things straight because when you look at a disclosure from a lender, you see homeowners insurance, you see sometimes flood insurance or hazard insurance, you see title insurance and mortgage insurance. Like, what in the world are all these? And what actually offers protection and what are you paying for?
Yeah.
So homeowners insurance is more easily explained because people are more familiar with it. Homeowners insurance is what you take a claim out on if a hailstorm comes through and damages your roof, or a limb of a tree falls on your house and cracks a wall. Something like this is what your homeowners insurance covers, and that's what's well known. Mortgage insurance is quite a bit different. So mortgage insurance is a insurance policy. It's a bona fide insurance policy similar to that, just in the way it functions. There's a premium paid if something goes wrong that the insurance policy covers. The insuree gets to take a claim and get paid out. So it's insurance in the traditional sense there. But what it's insuring is you paying the mortgage. It's not insuring a physical item. So the way that this works functionally is that if say, Matt, the hard times come on, and I'm sure they never will for you, but hard times come on,
you never know, right?
And you can't make your mortgage payment, and you enter the foreclosure process. Mm-hmm. Well, your lender then gets to take out a claim on the mortgage insurance policy, and they say, "Hey, look, Matt didn't make his payments. We're going into foreclosure. You insured his loan, so you have to pay us now." So the insurance company will write a check to the mortgage company because you foreclosed on your home. That's the protection that's provided from mortgage insurance, and it's protecting the lender themselves. This does have a little bit of advantage. It makes the mortgage industry safer and overall keeps rates lower than they would be otherwise because the risk of these mortgages is much less to lenders, but that's how it functionally works.
All right. Well, can someone opt to not pay, or otherwise, I guess, not pay their mortgage insurance? If not, can they pay off the required amount early? How does all that work out?
No, you really can't get out of it. So the one way to get out of it is to put down a 20% down payment.
Okay.
But if you fall in a scenario that requires mortgage insurance, there's no way to get out of it. Now, you can pay it up front. So say you're putting down a 10% down payment, not a 20%. So you do have mortgage insurance. You have an option to, and so the mortgage insurance, typically it's just part of your mortgage payment. You might see, what's annotated on there is PMI, private mortgage insurance. PMI of $50, $60, $70 a month, sometimes more. It varies quite a bit. But that is worked into the payment. The upfront option is when your lender, after talking to you, say, okay, you can pay this in a lump sum at closing, and then it won't go on your payment. The lump sum is pretty significant normally, in the thousands of dollars, and it's not very often taken. And I wouldn't recommend it in almost every scenario because it's one of these situations where the house always wins. They know what they need to charge up front to make it worthwhile. So just pay it monthly, and that way you only pay the least amount you'll ever have to when you sell.
All right. Is this applicable for the other types of loans that we discussed?
No, yeah. So this is an interesting point because I'll actually describe this differently than a lot of other people would. So the normal answer would be no, this is only for conventional loans, but that's really not true. So it's applicable for all of the non-qualified qualified mortgages. So of the loan types that constitute 90-95% of the mortgages in America, those qualified mortgages, the conventional, FHA, VA, and USDA that we've covered, those are the only 4 loan types that fall into that. Then with those, they each have their own flavor of mortgage insurance. So that was what we just discussed, is the conventional Fannie Mae, Freddie Mac's mortgage insurance. Yeah. FHA, the second most popular loan and probably the most popular for first-time home buyers, is they have what they call mortgage insurance premium. They have mortgage insurance too. It's worked in. The big difference is that the FHAs, never falls off. It doesn't matter if you put down 20% or you pay down the house halfway. It's on there as long as you have that loan. The VA doesn't have monthly mortgage insurance, but they do have a funding fee. So if a veteran buys a house, they use the VA loan, and it's their first time. There are a few exceptions to this if they have a VA disability rating, but typically if they do not, they're going to pay a 2 to 3% funding fee. They don't pay that out of pocket. It just adds on to the loan amount.
Oh, that's nice.
Yeah, it is nice, but that's in effect the same thing. That's an insurance policy to the loan to some degree. And then the final one, USDA, they have mortgage insurance as well. It's not as expensive as FHA's, but it's set up the same as it's on there forever.
Well, we got a couple minutes left on the show.